This is the last panel of our third annual Entering the Fall conference, and I am privileged to be up here. My name is Eric McArdle. Next to me, I have Hari Krishnan of SCT, Kris Sidial of Ambrus, and Sheng Wang of Wolfe Research. And the goal for today's conversation is to make alternative investments accessible. We've been in a market environment where alts have done a lot of heavy lifting and, quite frankly, have gotten a lot of attention. What we haven't always seen, though, is investor education and really just translating the complex into the simple, right, which is what we focus on here at Simplify. Before we kick off, I do want to encourage everyone watching this at home to visit enteringthefall.simplify.us and strongly consider making a donation to Coney Island Prep, which is near and dear to our hearts. So to kick it off, I'm just going to go down the list here and start with Hari. Hari, when you think about alternative investing, in your eyes and for the strategies that you manage, what makes an alternative investment effective?
Wow, that's a broad question. Anything that doesn't move in tandem with what people already hold is an alternative investment. That's the way I think about it, and I think it's increasingly important to have exposure to those sorts of things. And so I presume that most people own stocks. Many people own bonds, especially on the institutional side. So having strategies and or assets that are diversifying and or provide convex exposure to extremes is very powerful.
Kris?
Yeah, I think what Hari said is really important, right? On a stream of uncorrelated returns that really looks to provide a solution to something, right? So when thinking, kind of using ourselves for an example, what we do at Ambrus is we try to be a zero bleed tail risk hedge, right? So when markets are crashing, we're trying to have this large return that returns, 200 to 400%. When markets are normal, we're using a lot of short-term prop strategies to offset that bleed. So when you think of like the advisor that's been interested in like the long vol or tail risk space to seek a defensive alternative, they want that exposure, but they really don't want the bleed component, right? So I think when you're thinking about an alternative in general, it's one that's able to sort of provide a solution to a common problem that exists.
We're going to come back to that. I want to unpack that point here in a moment. But first, let's go to Sheng and get your interpretation of that. What makes an alt effective from your standpoint?
Yeah, sure, definitely. So I agree with Hari and Kris. So essentially, what we think is diversification is something much easier to get than alpha. Obviously, return is important. So a positive long-term return is something that's always a plus. Higher the better. That's something everyone knows. And then the risk, which can be measured in two aspects. One is the volatility of the strategy. The other is the maximum drawdown, which potentially could be more important because a low volatility strategy tends to have a lower drawdown, but it's not always the case. You can keep leading with a low volatility strategy. And then last but not least, and maybe more important than the others, is the correlation with your other assets. And that correlation can be measured as a simple correlation, but also potentially more important is the tail correlation. So whenever your other investments are losing, and that's something your alternative investment can shine. And if your a lot of the strategies, even the simple equity and bond, they can seemingly have a low correlation, but at certain times they become highly correlated, like financial crisis. So if you can find some strategy that can deliver extraordinary returns and uncorrelated, and that's what we think a good alternative investment.
Excellent. And there's something I want to come back to on that point as well. But first, let's kind of think about the typical advisor, the typical investment portfolio. Traditionally it's just been stocks, bonds, maybe some real estate, liquid or otherwise. But now the availability of things like volatility, of managed futures, equity long short, these are all now in listed products, whether through 40 Act fund, like a mutual fund or an ETF. And my question to you all is, especially coming from more of an institutional focus, do you think that these products can be good bridges to the end retail investor for getting high caliber, institutional caliber strategies? Or do you think that there is some type of let's say loss or something you lose in getting the liquidity access?
Yeah.
To anyone. Just curious, and this is more of just from like a general framework perspective. Like the landscape has changed a lot in the last few years.
Yeah, I'll go. I think it's amazing as to what's out there right now in the market. I tip my hat to the guys at Simplify, for kind of bringing this all together, because when you think of an environment like today, where the 60/40 is really underperforming and things are not moving in the traditional sense that they were, whether an investor really believes in a bullish theme on a product or a bearish theme on a product, they had the opportunity to express that. Whereas 10 to 15 years ago, you didn't, right? So you may be an advisor that's just growing a business and you didn't have exposure to swaptions or things like that, or, options that are embedded in ETFs. So I think when you look at the landscape today, you as an advisor trying to grow a business, you have more tools than you ever had, and in a time that, it's more crucial than it ever was before as well.
Let's stay with you for a second here, Kris. So you mentioned providing tail hedging with combinations of short volatility and long volatility. And I think that a lot of investors don't really think of their exposures as being short or long vol, but it would perhaps be healthy to think of their exposures that way, right? How do you feel about that? Do you think that advisors should kind of re-examine their allocations and think, okay, where am I exposed to volatility both on the short side but also on the long side? And then how would you go about even doing that?
Yeah, so to be clear, right, what we do is very different than what you would see in like the asset management side, right? So we use a lot of like active prop strats. So it may not be as traditional as just saying sell volatility to buy volatility. That's not really the way we think about going to do this. But not to say that that's inherently wrong, right? It's just not really our belief and our approach to structure this. Now, when you think of like long vol versus short vol, each have a fit in a portfolio, right? It's up to the advisor to make sure that they understand what type of risks are embedded in that, right? So if you're doing things like, okay, I'm going to sell, I don't know, I don't want to overcomplicate this, but if you want to sell X amount of VIX calls and buy X amount of let's say like some exposure on credit, right? So you're pretty much taking a bet that you're short equity vol and you're a long credit vol. You have to understand the embedded basis risks that come with that. So that starts with the educational process that the advisor needs to take, right? So it's really important to understand from the root what type of risk you're taking on before you engage in it.
How about just being long risk assets? Like if you're long SPY or you're long HYG, right? You're essentially short volatility, right? I think oftentimes the average portfolio is so concentrated short vol without ever understanding it, right? That when you go through an event where correlations move to one, you find that the diversification that I've built into this portfolio really is not diversification at all.
Well, I'm happy to address that point, which is an excellent one. Equities are short vol because everyone holds them. Bonds may or may not be short vol, depends on the regime. 60/40 though is short vol because anything that rebalances back to a set of static weights is going to be betting on mean reversion. Now, mean reversion is a feature of markets, but it's not the only feature. So one has to be cognizant or mindful of the fact that sometimes things don't revert, or at least they don't revert in time for you to keep your clients happy. I mean, I hear all the time that people, especially pensions and endowments, sovereign wealths have very long horizons. But does the guy sitting at the desk who's managing the money have an equally long horizon? Probably not. So managing that path, that wiggly path to that 30-year horizon is also significant and needs to be kept in mind.
It's a great point. We often talk to investors and advisors who build out a framework of having a permanent portfolio, right? They're really focused on, diversification or risk parity, right? And then what they find is that their clients sell out of the portfolio after year one or year two, right? So this idea of a 100-year portfolio never is realized, right? And so there's this tension, I think, of balancing out diversifiers with kind of staying with the herd, which is what the modern advisor complex is, unfortunately, they've been forced to do that in recent years. So focused on benchmarking that, having things that have some type of opportunity cost in a portfolio, like long volatility or like a absolute return profile, managed futures, equity long short, it just becomes too hard to keep in there, right? It's too much of a deviation from the benchmark. So how do you think advisors should have conversations with their clients around something like that? How do they set expectations? How do they coach people through periods where you are essentially going to lag a benchmark?
Well, this is the challenge. Sorry to hog the panel, but it's a challenge because line item risk is a big thing that I face whenever I talk to RIAs. So you may have the best hedging strategy in the world or the best protection strategy. It might be cheap, it might be powerful if anything goes wrong, but it's bleeding from month to month. Now you have a couple of choices. One is to take Kris's approach, which is to fund that effectively with other strategies. It's perfectly reasonable. The only question that the advisor has to ask is, are you taking another tail risk in an effort to pay for the risk that you're trying to hedge? And people have different approaches. It can work. The other approach is to simply try and embed this stuff in some kind of structured note or something of that nature. And nowadays we have, 4 to 5% rates. You could probably fund a hedging strategy in a principal protected note and do something like that, which would have been the flavor du jour in 2006, but is now no longer the sort of thing that banks are running to support. So I think the first hurdle is, if you believe in stuff that is truly convex, truly diversifying, and may hedge, you need to get the client to overcome this line item problem where they have 9 funds, they're all doing well, the 10th one is kind of piddling along, but it still has value.
Yeah. This leads to a really bad problem, right? It says not understanding the product well enough will lead to style drift. And in the defensive alt space, you see style drift all the time with the advisors, right? So here's something that is very traditional to see. CTAs did very well in 2022, right? This year, depending on what you're in, probably not as good. Now, you have this group of investors that, I'm giving you a hypothetical here, right? You have a group of investors that come in and they buy on, let's say, January 2023, right? And they experience 7 months of a decline in the CTA fund or ETF that they've been in, right? And now they say, I'm out of this. I'm going to long vol, or I'm going to tail risk. And it's so wrong, because when you look over the full distribution, right, you look over a full 4-year cycle, 3-year cycle, 15-year, whatever, you realize that the variance that you experience in this short time frame is not abnormal, right? So then now they style drift and they say, oh, we like long vol, right? Or like we like tail risk, and then tail risk underperforms, right? So as an advisor, you have to be very detailed in, 1, understanding the product, and 2, being disciplined about your process, because that this sort of back and forth effort, and I come from the trading side, right? So what we do is more on the trading side than like asset management, and you see this with very poor traders as well. When a strategy isn't working, they'll try to go and flock to something that is, and then it isn't, and those are the worst type of traders, right? Those guys are in and out of prop desk within like 2-3 years. So I think as an advisor, when you're building a business, you should take the time to understand the product, understand the process, and that gives you conviction to then relay that to the client, right? Because if the client is so obsessed over this one line item, you need to be able to have conviction to sit there and say, listen, there's a reason why this line item is there. We may be giving up 50 basis points, 100 basis points a year, but during moments of market stress, this is gonna add 500 basis points or whatever, 1,000 basis points to the portfolio, and this is really what it's there for. So I think explaining that comes from the advisor.
Right.
Yeah, I like the word discipline very much. So we come from equity long short type of systematic approach. So discipline is something very important. And we often see sometimes clients want to timing a strategy, essentially buying, allocate more to certain strategy than some others. But we typically more trying to advise clients more of a risk-based allocation rather than try to time the strategy. Because the correlation and the risk of a certain strategy is relatively easier to capture, but the future return is much harder to predict. And being disciplined is important because, as Kris mentioned earlier, that you don't want to move around and you might miss out even more. So what we are trying to do is we could do a historical backtesting, assuming the same data, same methodology, and try to see if that approach historically has been doing a good job in certain different market environments. Obviously, history may not always repeat itself, but at least this gives us certain levels of confidence, and especially if it's at a statistical significant level. And then in addition to that, to reiterate some of the transparency issue, that from equity long-short perspective, we can run attribution to explain to clients what type of equity exposure your for example, market neutral basket is getting at. So sometimes even your good exposure may losing money at certain period of times. For example, during the junk rally in March 2009 or even January this year, a lot of the short side stocks got rallied, and if you have a good quality exposure, you may lose money. But as long as you can explain to clients, and most of the clients, they still have long tilt positions that they own risky assets that benefit from that market rally. So it's fine to have certain types of drawdown that's explainable because, for example, some coming from a long-term premium generating exposure, but at short term, it may lose some money. So that's something we try to advise. And similarly, I think oftentimes what cannot be explained, and that's something clients find difficult time to adjust. And then we try to make more transparent in terms of the methodology as well as how the exposure looks like. And that gives a bit more makes clients feel more comfortable about getting certain types of exposure.
Well, that is the feature and the bug of an alt often, right? Is that you want something to have an absolute return profile, but being unpredictable makes it very hard to, know what it's, first of all, know what is happening under the hood, and then most importantly, explain to your investors or stakeholders what it's doing when, times are not great. So with that in mind, what are some risk or metrics of success that you all consider when either looking at other strategies or when investors are looking at your offerings? Obviously, in the advisory world, we talk about Sharpe, we talk about volatility, drawdown, right? So are there anything or any other metrics that advisors should put on their radar or consider when looking at these strategies?
Well, I can say what I do, but it may not be appropriate for the advisor community. I'm worried about bleed versus convexity. How much does it cost me to carry a position that expresses a strong view? And how much power or punch do I get if I'm right? So, I can apply this in various contexts. It could be hedging, where I'm saying how little can I spend to get maximum payouts given scenarios that clients want to avoid. In other spaces like, let's say, physical commodities, my goal is to say, how can I carry a position in a depressed commodity at low cost while providing long exposure to a longer horizon view? So for me, it's bleed versus power. But again, you have to deal with standardized metrics with clients, so you may think of it a bit differently.
Yeah. So, on the hedge fund side, what you'll often get is an advisor that will say, hey, I can't invest in anything that doesn't have over a 1.5 Sharpe, right? And I understand why they have these sort of blockers, but it's really, really ridiculous, right? Because when you think of something like a long convexity strategy like tail risk hedging or long vol, things like Sharpes, CalMars, Sortino ratios, those things don't really apply, right? Because you have something that is dormant for a long period of time and that can be explosive, in your benefit, and that sort of ratio then naturally becomes skewed, right? So it kind of goes back to understanding how can you compare this and what you should compare this against, right? So one thing that we do is we send out what you call like a hypothetical shocks and slides. Because if an investor looks at our month-over-month numbers, right, you're not really seeing much. You're not really seeing much variance, right? The portfolio is very steady. But, as a tail risk investor, clients want to know, well, okay, how much am I going to make if the market drops 20% in a month and vols go up 30 vol points across the board, right? And it's also a duplicitous thing where it's up to the alt manager to express this to the advisor, right? So it's this sort of bridge that needs to be there for the manager to express this to the advisor so that they could have some sort of an understanding as to how to standardize this, right? Because if they don't, well, they're just kind of in the dark and they're just trusting, you're going to perform versus, whatever other time scenario.
Yeah. I mean, I'm happy to give a short speech about both trend and vol, long vol. Trend is basically, this is my speech. If you trade 50 markets, 100 markets, probably 2 or 3 are going to move big, up or down in a given year. At least 2 or 3. You want to be part of that. You don't want to be missing out on that. So trend gives you that kind of exposure. Conversely, with long vol, I mean, one can think of a cycle. One thinks of the credit cycle, and you've probably heard of distressed managers who dip in 2009 and buy all this junk, and it goes up in value, or they buy when there's a severe sell-off and credit spreads are wider than they should be given default rates. Vol is the inverse of that, but it's the same idea. There are times of extended periods of complacency where low volatility breeds more low vol, and the spring gets compressed to the point where the tails actually flatten out. And so for me, long vol is a strategy that is designed to be as effective in principle as the credit, as distressed credit trading. Trend following is the ultimate FOMO strategy in terms of trying to capture big moves in the markets that do move, at least with a high signal-to-noise ratio in a given time. So.
One of the challenges with trend in general is that the first thing you often learn in investing is buy low, sell high. Right? And so if you're working with the average advisor and then their average clientele, you're already contending with kind of this preconceived idea. What would you say to that advisor or to that advisor client when it comes to trend strategies and why they're important? And I'll turn this over to Sheng for this one.
Yeah, sure. So a lot of the long-short equity type of used to be alpha, but now someone call it more of a risk premium. It's based on investors' behavioral bias. So trend following is some sort of behavioral bias. And obviously, there are lots of different behavioral biases. So cheap stocks might outperform over the long term. That's value. And high-quality stocks might outperform the junk stocks. That's quality. So all these type of risk premium, I think it goes back to your earlier questions that now the investors can access it much cheaper than 10, 20 years ago. So previously, the beta is just the equity beta or other sort of risky asset classes. They're typically short vol, as you guys mentioned. But a lot of the quant type of strategy, the market neutral equity strategies, they're also somewhat defensive. It's not necessarily 100% negatively correlated with equity market, but most of them are negatively correlated if you're market neutral because quant likes defensive stocks, low volatility stocks, and shorting those junk stocks, which tend to be riskier. So that type of negative correlation also helps to bring down your overall portfolio's volatility. And in terms of sort of a behavioral bias, I think quant is very good at capturing the long-term behavioral bias. So something we can not only make intuition out of it, but also backtest the historical performance. So sometimes that intuition works, so that will give you a long-term risk premium. And then ideally, if you can overlay it with some more sophisticated method, then that becomes a alpha rather than a risk premium. So if you keep betting the same exposure, that's more of a risk premium. Like people also call it smart beta. So it used to be alpha, but now it's a beta. But if you are sophisticated enough to build some more complex model that can time it a little bit, so then it becomes more of an alpha. And what our philosophy is, you can get beta very cheaply. So investors should focus more on adding uncorrelated alpha on top of the getting relatively cheap beta. So in that case, it's more efficient in terms of the asset allocate. So and oftentimes, some hedge funds definitely add a tremendous value in terms of generating consistent alpha, but there are also certain hedge funds, they may not necessarily having that type of consistent alpha, but a lot of it's beta. So what we recommend is more of getting cheap beta and then focus on high quality alpha so that it's more of an efficient way of managing assets.
Yeah, on the long vol side, I think there's 3 standout points, right? When you have a defensive alternative like that, you reduce the variance in your portfolio, which in turn, you're able to compound returns at a higher rate, and the ending geometric return is significantly higher, right? So there's a very easy mathematical understanding as to why you should be reducing the variance in your portfolio. The second thing, the more realistic thing, is the clarity that this brings to advisors during those moments of market stress. You have a sense of peace knowing that, okay, I have a backstop in case the market were to drop another, 10, 15, 20%. And that clarity is so important, right? Because most advisors are emotionally driven by the emotions of their clients. And that's a big problem, right? So as an advisor, it's your job to be able to make those decisions on the fly. And if you're in a point where you kind of have your back against the wall, you won't be able to have that peace of mind and that clarity to be able to perform. March of 2020 was a great example for this, right? You had advisors that were buying up things like Apple discounted down 40, 50%, and other people were more so panicking out. And the third point to that is that, ironically, for an advisor, this is so crucial in growing a business because you have those large shakeups of clientele during those moments of market stress, right? So, and in the advisor community, generally what you get is when the market's down, what is the saying, right? Misery loves company. All the advisors get together at the bar and they're like, oh, well, the market's down, what can we do, right? And that's just such a poor approach to it. But the smart advisors are able to then benefit from the fact that they aren't down and they end up taking that sort of clientele. So we could go into the mathematics as to why defensive alternatives are important, but there's a more humanistic side to this as well.
Yeah, I'll do a shameless plug for myself, which is that one of the things I've always focused on is regime-based hedging. So finding the best hedge given the state of the world now. Most people don't want to hedge when hedging is cheap, and that's almost by definition because that's why hedging is cheap. There's no excess demand for buying options premia. And so the real goal is what's the best hedge you can stick on given current market conditions. So if there's a little bit of fear in the market, there's still things you can do that are effective and that may not be too expensive. The last thing you want to do is pull the panic cord when the VIX or vol is at 60 and then go out and buy a boatload of options because then you're playing a losing battle. What you need to do is to have a suite of techniques or funds or ETFs that you can deploy in a reasonable way given the state of the world. That's something that your setup is really effective for. If RIAs have a good feeling as to when various ETFs will perform well, then they have, calculated reasonable responses to stuff going on in the market that would otherwise get people to pull their hair out. And I think that's really an important thing, having a plan that isn't purely based on assets, but also on strategies deployed on assets.
So if this topic wasn't challenging enough, now stack on top the fact that the advisor is managing a business, and they have to do this at scale and across different client types. And a friend of the firm, Corey Hoffstein of Newfound Research, does some work on rebalance timing luck. How would you all suggest, if you're running these ensembles or multiple strategies, and you want to have the benefits of diversification, but still have a business that you can run without losing hair or sleep, do you just suggest rebalancing every month, every quarter, every year? Does it depend on the exposure? Should you do, varying or random rebalances? What's your reaction to that question?
Well, Corey spoke to me about this once in the context of hedging, and he said, well, I'm really flummoxed because the timing of my rebalancing strategy for, say, an S&P put buying rule has a huge impact on my P&L. How can I reduce that? And he's right. And this is sort of a general problem with timing or rebalancing across various seemingly decent alternatives, which is why I do focus on finding the dog for the day, or the best dog for the day, where you do reduce emphasis on timing because you're not thinking in terms of enough is enough, the S&P's dropped 20%, I'm out. Instead you think, well, maybe the S&P's down 20%, so put buying is an expensive strategy. Maybe I should do something else. Maybe I should buy spreads. Maybe I should go into a different market. Having those options that are well conditioned to the current state of things, I think is very powerful. And it automatically allows for rebalancing because you say, not enough is enough for the S&P, but enough is enough for this strategy. Let me go into another strategy that still keeps me safe if things get worse.
Yeah, look, I'll just speak to it from a trading standpoint. So what we do is literally by a second-by-second basis, right? So when you're managing a portfolio like, a portfolio that's allocated from 1 to 6 month vol, full of tails, you really need to make sure your exposures are in line, right? And this is where you get into things like weighted vega exposure, your correlations, right? The basis risk that you're taking, all sorts of different sort of like funky trading stuff. But what I would say is, as an investor that's looking to invest in a defensive vol, that's so crucial. Oftentimes, I'll have potential clients that will come to us and they'll say, well, you know what, we like what you guys are doing, but we don't really see a tail hedge on the horizon. And it just blows my mind because I'm like, well, categorically, if you could see a tail hedge on the horizon, it wouldn't be a tail hedge, right? So I never really understand this sort of view where you get investors that try to time their defensive hedges. So to me, that's more so like a philosophical thing. Being on the trading side as a hedge fund, we obviously understand the components that go into structuring a book and what it needs. But then the client trying to time that is a whole different ballgame. So, I think that a lot of people don't understand how that sort of timing delay can really destroy returns. And even in terms of like buying options, right? I don't think people really understand the realistic matter of optionality and the prices that you buy these at. Right, you buying an option at 50 cents, that the option goes to $1 versus you buying it at 5 cents and the option goes to $1, right? Same exact option price, 2 completely different return profiles, right? Completely different. So I think that's a big thing in the defensive space.
Yeah, for us, I guess rebalance means 2 things. One is our strategy's rebalancing frequency. The other is potential clients' asset allocation rebalancing frequency. So some of the strategy, if signal decays faster, it might require a weekly or even shorter rebalancing frequency. But that's a function of the signal decay and transaction cost. So a higher frequency will incur more transaction cost. So if after cost, it may not necessarily be as appealing as before cost. Usually with a higher rebalancing frequency, you will see a better risk-adjusted performance on a single strategy perspective for the long-short equity, but it's not always the case. If your signal is very slow, fundamental-based, you don't necessarily need to rebalance weekly or not even semi-monthly. But then the other aspect is more of an asset allocation perspective. So, for example, if you hold 11 assets that on the monthly basis, assets, because some might go up more than the others, and that will be drift of different asset classes. And then you want to get benefit from diversification, then you need to rebalance. Otherwise, your winning asset keeps getting bigger weights, and at some point it loses, your asset becomes much more risky. So you can use different weighting methods. So risk parity was a well-known method, and we also have some more of a tail dependence where it measures the correlation at tail level. That's also another risk-based asset allocation. So that we typically advise clients to do monthly if possible, since that will make diversification more available. And there's another thing that's also related is when people calculating correlation, they should use the same horizon as their rebalancing frequency. So for example, people look at equity and bond, they think they're negatively correlated, but that's on the daily frequency. If you look at the monthly frequency at the more of a recent history, it's actually still positive. And most of the asset allocators, they're not rebalancing on the daily frequency. So that negative correlation from equity and bond, you may not necessarily be able to capture that if you're not rebalancing on daily basis. So that's also something we try to educate clients to align their rebalancing frequency as the way they calculate correlation, because that's what really matters. So some of our strategy that rebalance monthly, that at the monthly correlation, it's more negatively correlated with equities than bond. But if you look at daily frequency, it may be less correlated. But if you're rebalanced on monthly frequency, it's probably better to do those monthly negative correlated assets, and then use that correlation for the asset allocation.
I'm glad you brought it back to correlation and brought it to a monthly time frame, because obviously we've gone through very difficult markets where especially the stock bond correlation has changed on investors, and arguably you could say that it's really just returned to its long-term correlation, but we've become so accustomed to stocks and bonds balancing each other out that 2022 is quite difficult, right? So when you're modeling or you're building strategies around correlation, what types of tools do you use? And specifically, I want to focus on machine learning, which is not necessarily available to advisors, but is going to be a greater and greater part of strategies that advisors have access to. So Sheng, I'll go back to you on this one, because I know you all do a lot of that at Wolfe. Mm-hmm. How does machine learning play a role in your processes?
Yeah, sure. So we started to explore machine learning more for stock selection over 10 years ago. So we work at Deutsche Bank at sell-side equity research, and we were probably the first sell-side that used machine learning to do stock selection. So machine learning works better when you can have hundreds, if not thousands of bets. So that's fit very well into the equity long-short framework, because every month you can bet for over 1,000 stocks, and some to long, some to short. And you don't need to have a high hit rate. As long as it's slightly above 50%, then you can have a positive long-short returns. And machine learning is very good at picking some of not necessarily easy to find by human eyes type of relationships. So what we've used is more of a variation of ADA boost algorithm, where you can combine multiple weak classifiers. In this case, we use a traditional equity factors, and combine those weak features together. You can build a strong classifier to classify the outperformers over the underperformers. For human, you can still use a linear multi-factor model, but that's less sophisticated, but also it may not always capture the nonlinear relationship. So machine learning, you can capture some of less linear relationships. So for example, in the equity space, historically, probably high momentum stocks outperform low momentum stocks. But if for a certain market, when momentum is crowded, the extreme end may not necessarily be the best place to bet. Sometimes you may want to bet on the second highest momentum stock and short the second lowest momentum stocks. In that case, machine learning can help you identify some of those nonlinearity and combine multiple factors to make sure that the combined one is much more predictive than your single factor model.
So when it comes to using these multi-factor models, and I want to kind of break it down here for a sec. So we have all of these different inputs, all these different factors and time horizons. Is the idea behind a machine learning strategy just to re-weight and basically prioritize certain exposures at certain times and then deprioritize? Is that a fair statement?
Well, it's such a broad question, a very good question, but such a broad question. Just give you some examples. That's the best I can do. So seasonality, let's say in commodities, is hard to deal with standard techniques. So the tendency for natural gas to be higher priced in DEC in December than it is in the spring, or the tendency for certain futures contracts in grains to have sharper decay rates going into harvest, stuff like that is very hard to deal with standard methods. So having models that can tease out more of the regime or temporal specific dynamics is at least what we use machine learning for at SET. Now, SET has been doing it for 20 years. I'm a newbie in the space, relatively. I don't want to undersell myself, but relatively. And a lot of those sorts of things that are really hard to model using standard techniques are great candidates for machine learning. As was pointed out, machine learning does really well, or relatively well, with large masses of data that look the same. It will never solve the tails problem, which kind of brings you back to Chris's world, which is that there's not enough data, there isn't enough notion of the dynamical process of leveraging and deleveraging that drives the tails to really use ML for that. But it's an incredibly powerful tool for us in areas where it's just too thorny to use standard models, even whatever, logistic models and things. They just don't do the job. So we use it for regime-based stuff.
how do you think this will impact markets in the future? Let's move a little bit more toward the abstract. And, obviously markets are getting faster. Information spread is getting faster. Access to different instruments is, again, more widely available than ever. Do we think that this has any impact on how markets will behave? Or is it just a fad? Or love your perspective here.
Yeah, I'll be brief on this one, which is that my colleague Vasant, basically he says that finance is probably the worst place we ever could have started in machine learning because there's very low signal in finance. For most markets, most liquid markets, the signal is really low. You pointed to 52% success rates as being a huge winner if you can do enough of it. True. But the damage that you do by getting it wrong if you size appropriately and you use appropriate risk management is also low. So doing a lot of machine learning and teasing out fine structure is great. Having said that, I personally don't believe that machine learning in finance is the be-all and end-all. I mean, if I were a pure sales guy, I would come up and say, in my head, the best way to get people to buy something is to make them scared, right? So if you're afraid that machine learning is going to take over, you'll want a piece of my machine learning business. But it isn't quite so simple because, as I said, there's so many factors. The system is so highly dimensional. There's so many different agents in this massive network. It's very hard to get strong results using out-of-the-box machine learning techniques.
Let me ask a different question. Does valuation still matter in today's markets?
I'll take this one so again, everything that we do is on the trading side, right? So flow matters tremendously, and over the last decade, I think a lot of people who were very focused on value found that out the hard way. But the devil's advocate to that, or really the side that I'm on, is I think when rates are moving at the rate that they're moving right now, I think it's very difficult to not understand that valuations matter to some extent. And again, I'm purely on the trading side, right? Just everything we do is flow-based, everything we do is trading-based. But now you're seeing larger asset managers who did not give credence to certain, economic data or certain valuations and things of that sort now change their tune. And I think you're seeing this move consistently, especially across some multi-strat pods. So things that may not have been in play, 3 years ago, people are trading with 4 times the exposure. And I think that that's very impressive to see. Now, I think it's undeniable that flows are driving markets to an extent. I mean, if you sit there and you spend a couple hours of your day just looking at the S&P price action or single stock price action, you could see that some of the flows driven from the options market is very notable, right? It's not a sort of a finger in the air sort of guesstimate. It's actually happening. But I think in the short term that's occurring, but I think over the longer horizon, you're starting to see investors move over towards the understanding that, hey, rates are at whatever, 5, 6, 7%, these valuations are going to start mattering.
Yeah, I agree that fundamental still matters because even for machine learning, we use fundamental factors that as input to the machine learning. And historically, those fundamental matters. And what machine learning is trying to bet is just what worked historically and hoping it works in the future, but in a more sophisticated way. And to a certain extent, it's like quant will never replace fundamental completely. Machine learning will not replace the traditional linear multi-factor model completely. It's just more of a, one is at different frequency. So machine learning could potentially better at a higher rebalancing frequency, and not everyone is in that game. So longer term, you could still have certain type of long-term valuation matters that machine learning may not necessarily be able to arc that away. It's similarly like fundamental managers. Some they look for multi-year horizon, which is to quant. I think few of the quants are rebalance on the yearly frequency or rebalance any of their positions that long term. But machine learning, some of the higher frequency ones purely based on price and volume, that may be less fundamental driven, but that's having much smaller capacity and it may not necessarily be as scalable. And the machine learning that we are trying to explore is more of a fundamental base, which fundamental definitely matters. And that's the long-term behavioral bias that we are trying to use machine learning to explore rather than by naively human intuition.
Well, the question also kind of blows my mind because I'm convinced of a few things. One thing is that we understand that fundamentals matter less than we thought they did 20 years ago. So whether it's the Mike Green world of passive investing or flow-driven trading, options activity and its feedback on the underlying markets, that's all in equity land, but there are other examples in other markets. We understand that fundamentals are not the only game in town, and probably that in itself has affected the dynamics. To the extent that people believe that fundamentals are the be-all and end-all over reasonable horizons, they are quite important. And I think, obviously, at the end of the day, once you drift into the private equity space or in that direction, cash flows are what matter, and real things are what matter. But certainly, it's more clear to a larger number of people that this complex interaction between all of these flows and beliefs and fundamentals has become more important.
Sure. So. I want to wind down by asking you three, who are clearly intelligent, you've given this a lot of thought, how do you manage your own personal assets? What do you prioritize for, and how do you think about managing risk for yourself?
Yeah, well, I mean, for me, this has changed a lot. I used to be an absolute Luddite when it came to managing my own money, but that's changed because I've been in contact with various people, and I have bought into various long-term secular views, one of which is the commodity supercycle, whether it's based on food security or other factors, lending itself to having longer-term structural bull market views in positions that I previously would not have taken. So I have drifted from being a ultra boring, less in equities, more in bonds guy playing the yield curve, to being someone who actually wants to take structural views over longer horizons and is actually trying to encourage clients to do some of the same stuff.
So would you say you're less active now than you were in the past?
I was never very active, but I'm certainly sticking to some core views in ways that I never used to. Yes.
Yeah, for me, this may be a hot topic or non-traditional, but I come from the prop trading world, right? So I come from a space where you see CAGRs of like hundreds of percent, sharps or 3, right? That's just not conventional to the asset management side. Granted, these strategies are capacity constrained, right? So you can't scale these to like, $200-300 million. But I also have a philosophy where I follow a rule, the no skinny chef rule. So my own money is in the products that we have, just because of that sort of philosophy around trading capacity constraint edges. Also, I don't believe that I'm a good investor, right? So for me to have the view that, all right, I'm just gonna buy the S&P or buy some single stocks, that's just not how I was trained. Not to say that there's anything wrong with that sort of approach. It's just, the philosophy of trading has been embedded in me in a very different manner for starting. So I'd say, all my capital's in my own funds.
Yeah, so for me, I'm pretty passive. So I'm basically investing in a bunch of ETF that have a low expense ratio and mostly passive investing. And then, just as I mentioned earlier, I try to get cheap beta. So for example, I will buy the Vanguard version than SPY because it has lower expense ratio, because I don't necessarily rebalance that frequently. It's more for asset allocation. And then I try to find uncorrelated assets, anything that's available via ETF. And because I work at the sell side and we need a 30-day holding period, and I don't want the hassle to rebalance. And usually, whenever it drifts too much, I just do a little bit of rebalance. And the weighting-wise, it's more of a risk parity. So most of the ETF, you can get the returns, and I just run some simple risk parity. And I don't think I could add much of alpha, but I think diversification is something that I can get easily. And the weighting-wise, I don't need to be accurate to the second decimal place. I typically just run it up, and whenever certain asset classes did well, I might just rebalance it similarly when some underperform. And if I can find some new vehicles that newly available via ETF, I'll do it, because for myself, it might be a little bit harder to access some of more complicated products, and ETF is probably an easy place to start.
Well, you know that resonates with us, right? I mean, obviously, as an ETF provider, most of the clients that we work with in the advisory space are doing something very similar to what you described, right? Utilizing cheap beta, cheap exposures for the asset allocation piece, and then increasingly moving towards alternatives that can provide diversification benefits. So for the lightning round at the end here, I always like to pick the brain of folks like you to know, what are you reading? What informs you? What do you think the average advisor should be paying attention to for the next 12 months? And this can be a YouTube channel, it can be somebody's blog. I'm just curious what you find interesting these days. And if you need a second to think about it.
Well, I mean, I would have been the last person to say this. I find farming incredibly interesting. I watch tons of farming videos. I watch advice on when to sell grain, get it out of the bin and sell it. What's the best month to do that? What's the best way to hedge your crop before you put a seed in the ground? All this stuff, which I think is kind of the future, kind of the antithesis of AI and machine learning, but which will never go away because I still have to eat and still have to drive around and stuff. So I've become extremely interested in that world. I'm not fully politicized in the sense that I'm not saying that the Green Revolution will fail and we need to use nuclear, this, that, and the other, although I'm fully aware of that stuff and I do have sympathy for it. But I'm totally on board with stuff like Alexander Stahlman, his blogs, a lot of the stuff that some of the University of Minnesota guys do on the grain side. All of those things I find have really richened my experience in terms of understanding the real stuff that underpins the world. There was a book by two Bloomberg authors, it was on the grain traders and Mark Rich and so on. I wish I remember the name. I read it zealously. But I'm really in the commodity space at this point.
I've been learning how to make steaks, so I find that stuff interesting. All jokes aside, again, I think what we do is just slightly different, right? So we don't really focus on thematic narratives. It's more so process. I would say, as an advisor, they should really look to explore some of the alternative space and dive into the work that's been embedded there. You know, Ari's wrote some great books, in terms of looking at long vol, tail risk hedging, because one thing that I often come across is the advisor who gets prompted by his client, and I think you don't want to be that advisor, right? Where the client comes to you and says, "Hey, can you look into long vol for me?" And you're the advisor that's like, "Oh, what's that?" And now you're trying to read a Black Swan book by Nassim Taleb, right? It's a very sort of poor approach, especially because you have a fiduciary responsibility to these investors, right? So I think investors should always be, diving in deeper into newer applications and learning about alts in general. Right now the macro landscape has offered a ton of opportunities, and advisors that have been doing their work for years are participating in this. Right? It didn't come out of left field that rates were going to go higher, right? People knew this for years and were preparing on this for years. So I think it's important to really dive into the alt space and get to know the products and the process for 2-3 years before maybe you invest. That's honestly the biggest sort of advice that I would give there.
Very quickly, the book is The World for Sale. Javier Blas is one of the authors.
That's excellent.
Thank you to Mark Roberts for that one. Okay.
So we are focusing a little bit more on the AI space. So we built AI thematic baskets. So a little bit different from typical approach to fundamental driven. We are more systematic driven. So we try to use natural language processing to look at the company's core transcript. At the same time, we also look at the patent filings. So we combine the two to look at companies that not only talking about doing AI in their future, but also have competitive filings. And we build a AI basket. And more importantly, we try to make it market neutral. So oftentimes, if you just naively long any sort of AI names, you will get exposed to some sort of growth exposure and definitely market exposure. But if you believe in a longer term AI, but you don't want to have that much volatility along the way, then we try to bet on some of a market neutral version of AI with a sort of competitive advantage, which is from their patent filing and what their management is doing. So, and also using the tools of machine learning like natural language processing. So we find that's also fascinating, and we can the beauty of it, we can run backtesting because all those data was available at each point in time, and we can see how that performed historically and get a sense of how the upside versus the downside, and then feel more comfortable about building that type of strategies.
Well, you've sure given me a lot to think about. And Hari, Kris, Sheng, very much appreciate you being here today. Thanks to everyone at home for watching.